Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to take a look at Tanger Factory Outlet, an outlet mall. And I'm producing this video in conjunction with an excellent article written by my good friend and REIT expert, Brad Thomas. And Brad produced his article, and you can read his written portion. And he gave you some really good insights into the company, the management, what their operating challenges are, and how management has stood up to those challenges over time. My view here, my purpose with this video is I want to kind of give you a dynamic look at valuation of this company historically. And what I've got here on the board here is I've got funds from operations, which is an appropriate metric to value a REIT. And I'm going back to 2006. I'm going back to just prior to the Great Recession. And I want you to know that this orange line here is 15, represents a price to FFO of 15 times funds from operations. And I want you to notice that coming into the recession, the stock correlated to that FFO line very closely. And then as we came into 2011, 12, etc., we got into a position where the price to FFO got kind of high, up into the 20s. And we did have good performance on the stock during this period, but then once it kind of peaked at a price to FFO of 21, I do want you to notice that we had, really flat performance here for several years. So in other words, what I'm suggesting is valuation got a little high, and then it stayed that way. Really, there was no performance or very little performance other than the dividend, which kept increasing, as you'll notice here at the bottom of the graph. But then as we talk about the Amazon effect and, online trades and so on, and then we've got a lot of retail companies that look like Tanger, we've seen the price drop dramatically. Now, we have had some weakness in operating results. Funds from operations, as you can see, expected to weaken in 2019 and 2020 before they're expected to kind of flatten out and level off. But my point is, this price reaction is, as Brad pointed out in his article, is excessive pessimism. This is a very strong reaction to what is not really that big a problem. We saw some weakness in FFO coming out of the Great Recession, but the stock price, held up pretty well. So what I'm suggesting here, if this stock was trading at a normal price to FFO, it would be about $32 a share, or more than double what it's currently trading at. And I think that's really where your opportunity is here. So let's look at some other valuations. While I'm looking at Tanger here, let's also look at it from a standpoint of EBITDA. Again, EBITDA is kind of a form of cash flow, and it's earnings before interest, taxes, depreciation, and amortization. It doesn't necessarily apply to REITs as much as it does other regular corporations, but I do want you to see the stock has traded at around a 10 times EBITDA, and I just feel that that's a rational valuation. And so once again, if you valued this based on price to EBITDA, you would have numbers approaching 30 again. So another valuation metric that indicates that the stock price is undervalued. Now, if I go back to AFFO here for a moment, I then want to add another valuation reference that I utilize quite often when I'm looking at stocks, and that's the dividend yield. So I'm going to put the year-end dividend yields, that's this maroon or burgundy line on the graph here. And what I want you to notice is the inverse relationship between yield and value. When the dividend yield was up here at 4% back in 2008, 2009. I'll expand this out a little bit just to give you, I think, a little clearer perspective. I'm sorry, that's as far as I go with AFFO. I apologize. Thought I had FFO here. So when you had 4% yields, you had low valuation. Then as valuation got high, we start seeing the yields falling into the 2.7, 2.4% range. And then at the lowest yield, which was 2.4% in December of 2012, that's really when the stock price kind of peaked and did nothing, as I mentioned earlier, for a couple of years. But if you look at this long-term valuation, I'm going to go ahead and move this now to FFO, which I have longer history. A lot of REITs have only been producing AFFO data for the last 8 or 10 years or so. So let's look at this same perspective, and now let's look at FFO over a longer period of time. And again, I'm going to shorten this time frame to just before the Great Recession. And now what I want you to see is we had last year's year-end dividend yield was 6.9%. That is currently ballooned to 9%, strictly related to the fact that the price has gotten so cheap. So when you see high dividend yields, as you did here, you see low valuation followed by rising stock prices. When you see low dividend yields, like you did here, you see relatively flat to very little, obviously capital appreciation. So the point is, even though this company is going through some challenges right now, as Brad points out in his article, there's a lot of depth to this management team. They're quite experienced. This company's raised their dividend for over 25 years. I don't know the exact number. I don't recall it off the top of my head, but you can see the dividend increases here have averaged about 6% From a capital appreciation point of view, this stock has underperformed the S&P 500 here recently over this time frame. This is from 2006. But again, take into consideration that's because the stock is so undervalued. If I doubled this valuation, you would see that it would be much more comparable to what the S&P does. But the income advantage is really worth noting. This company generated over $6,000 in dividends versus $2,800 in the S&P. So if you're looking for income, that's really one of the fortes of REITs here. So let's go beyond this and let's look a little deeper under the hood and a couple other things that I think we ought to talk about. One thing I don't want to avoid elephant in the room, and that's the level of debt. So next I'm going to go into what we call our fund graphs, which is financial underlying numbers. I'm going to look at some balance sheet data. Let's start with assets per share, and this is a per share data. I'm going to shorten the time frame. As you can see, the assets of this company have grown nicely. They're down a little bit from last year. If you look at it on a quarterly basis, they've held at around 25, for the last several quarters here. So assets growth is reasonable here, and this is per share data we're looking at. Next, let's take a quick look at book value. I think book is reasonably relevant to REITs because of the properties they own. Book value is holding up nice here. It's, trading at, it has a book value per share of about $5.15. Again, we're looking at per share data here. Next, let's take a look at debt. If you look at debt per share, you can see the debt per share is about $18 per share, but now let's look at long-term debt per share. And what I want you to notice is that long-term debt, it represents the majority of the company's debt, which means it ties in nicely to real estate. They get to amortize this debt quite well. So I think their debt is obviously manageable. And to evaluate that, let's look at something that you don't normally look at with REITs. Let's go ahead and look at free cash flow per share. Here I'm looking at a time frame going back to December of 2011, and you'll notice that the company's cash flow per share their free cash flow per share has been growing nicely. This is, like it would with any company, this is cash left over after paying obligation. Remember, REITs have a special capital structure relevant to their funds available for distribution where they have to pay out 90% of those. This is just simply looking at, do they have the ability to continue to run and operate their business? Next, I'd like to take a look at some common measurements of a company's profitability. Let's go ahead and look at their gross profit margins. And again, I'm going to shorten the time frame since coming out of the Great Recession. You'll see they've been maintaining 40%-ish gross profit margins consistently. Their net profit margins have actually been quite good. In 2015, they actually generated more net profit margin than they did growth, and that had to do with the fact that their cash flows were so strong. I look at gross and net margin quarterly. One thing I do notice that the September quarter tends to be weak as far as net margin goes. That has to do with their accounting structure. That's something to take a look at. But they've got, good margins, and their margins are holding up. Their returns on assets have actually been, this is quarterly data here now, have actually been increasing recently. And it's, it was very, very high back in 2015 and 16, which I alluded to earlier. But again, their returns on assets are holding up. Their returns on invested capital have fallen a little bit, and a lot of that has to do with some store closing and things that Brad covers very nicely in his article. Next, I want to take just a quick look at share count. Since 2012 or so, I want you to notice that they've maintained about 93 to 95 million shares outstanding. I think that's very good for a REIT. A lot of REITs are constantly raising capital. Tanger has been able to maintain their share count pretty nicely here over this period of time. And then next, I just want to take a look at revenues. The company's revenues have been very, very good. As you can see, they've increased over 499 million. If I look at this quarterly, you can see their revenues have been holding up, even though there's been, some issues going on, as Brad covers, with some of the companies that are in the Ascena portion of the company's clientele or lease. Anyway, going back to the basic fast graphs here, I want to reiterate the valuation here to me is compelling. This to me is pessimism. I think even though this company is having some issues, it's not the first time. This is a very adept management team. The company has great cash flows, as I showed you earlier. You can see their funds from operations would warrant a much higher valuation than currently. In other words, this is a significant overreaction or way more pessimism than I think this company deserves. So here you got an opportunity to buy a really well-established REIT with a great long-term dividend record, providing you a current 9% yield at a very compelling valuation. And as Brad points out in his article, if you're willing to hold this for, let's say, 5 years or more, I think you'll be extremely happy with your decision to buy this stock. And of course, that's assuming that nothing changes, but part of the due diligence process is paying attention to the company and how they're performing. Anyway, this has been Chuck Carnevale taking a look at Tanger Factory Outlet. I am long the stock. I do consider it significantly undervalued, and I think the fear of the Amazon, Brad covers that in his article, effect is over-exaggerated. So this is a great time to buy a great stock at a good valuation. Thanks for watching.